Good morning, ladies and gentlemen. My name is Impairments. I'm the head of audit for RSM South Africa, and with me is Michael Steenkamp. He is our head of IFRS Technical, and we are going to take you through a couple of the accounting considerations that you need to keep in mind when reporting in terms of either IFRS or IFRS for SMEs, and specifically relating to the impact of COVID-19, the recent events. I just want to say before we start that we only have 30 minutes, so we're really only going to touch on some of the most pertinent issues that Mike and I have come across in the last week or two. There's actually a lot more, and I'm sure you see a lot every day. So if there are any more questions, please be in touch with us, and then we will be able to try and guide you through the process. So we're going to start. I'm not even going to have an agenda. We only have 4 or 5 slides, so I think it's good enough to just jump right into it. And with that, I'm going to just hand over straight to Mike Steenkamp.
Good morning, everybody, and thanks for the introduction, Henk. So my part of the presentation is really just going to be around mainly the accounting side of things and certain impacts that we've come across and questions that we've had in the last while dealing with COVID-19 and what might the impact be on the accounting records of a company during this time. Obviously, in South Africa, we'll deal with IFRS and IFRS for SMEs. So it is a bit of a mixture. Some stuff is applicable only to full IFRS and others, and not necessarily to IFRS for SMEs, but I will distinguish those parts of the presentation. Firstly, the main area I think that's going to impact most people during this time is impairments. Impairments come in various shapes and forms. In full IFRS, we're dealing with IAS 36, which is the impairment of non-financial assets, and we've got IFRS 9, which deals with financial assets, and then also SMEs, that's section 11 and section 27. So the first area that I think is of relevance to look at would be the impairment of inventory. So obviously during this period of time, specifically inventory that is slow moving, often companies have policies in place for slow moving inventory. And now obviously with everybody being at home and the lockdown that we have in South Africa, there's no inventory moving whatsoever. So obviously that is an area that would need to be considered with regards to those provisions being raised, and also those companies that carry inventory with expiry dates. If you're maybe in the food industry or something like that, or the pharmaceutical or medical industry, you might have inventory that is possibly going to be expiring over this time as well, that you would not have anticipated, and provisions might need to be raised for those. So that's for inventory. And then the next one I'd like to look at is specifically in the last 18 months, we all would have been running around dealing with the whole concept of ECL, expected credit loss, in terms of IFRS 9, and that is for any financial assets that are recognized at amortized cost. The main area which that relates to, which everybody is affected, that apply for IFRS, is that relating to trade receivables. So obviously, you would have discussed a lot of this with your auditors in the last 18 months, or attended webinars or our webinar, or done read-ups on this. And there's a whole lot that goes into the calculation of expected credit loss. And certain areas like your probability of defaults and your exposures at default. During this time, those assessments I think would need to be revisited, especially when calculating your expected credit loss, as those assumptions would definitely have changed. The probability of default would have increased. Maybe your definition of default would have changed, possibly, and your exposures at default now, should your customers reach those default levels or default points, that the exposure at default would definitely have increased as well. So that is definitely a big consideration to make in calculating your expected credit losses. And likewise for SMEs, I think if you're looking at your SMEs, is still the way that we used to, the old way we used to know it, of a provision for bad debts, which is so that terminology is still applicable to SMEs. Likewise, that might change as well in these times for debt that might not be recoverable or might be doubtful during this time, based on what happens to your customers, should customers go into financial difficulties or liquidation or whatever it might be. The next area I'd like to look at is PPE. Obviously, impairments of PPE just needs to be looked at and considered for PPE that is idle. So if PPE is idle during this time, is there any impairment indications there that might need to be considered? And the other one, which is an interesting one, which is a question I've received a couple of times, is what happens to depreciation of PPE during this time? The standard IS 16 actually quite clearly says that when an item of PPE is idle, depreciation still carries on. It doesn't stop, it doesn't cease during this idle time, and you would still need to depreciate that asset, and that's in line with IS 16. And that will be similar to SMEs as well. Then the next one, which could be is quite an interesting one, is that of intangible assets. We all know under full IFRS, if we carry goodwill or indefinite life intangible assets, that we don't amortize those, but we have to test those annually for impairment. And normally, the common way of testing for impairment is a company would do a discounted cash flow, a DCF on that specific cash generating unit that relates to the goodwill or the intangible assets, and we would test that asset for impairment. Obviously now the assumptions used in the discounted cash flows will all, I would assume, change during this time and maybe forward, because there'll be a long-term impact possibly as a result of this lockdown period and of COVID-19 in the months to come. So those projections and forward-looking assumptions might very well change when you are testing those items for impairment or doing those discounted cash flows, as well as your weighted average cost of capital. That will also change. Your risk rating might go up and things like that. So your discount rate will be very different. So that is just another item to consider there. The next area I just briefly want to look at is that around revenue recognition. And this is also a couple of questions that I have received so far from clients and things like that. Is obviously, again, likewise with IFRS 9, we would have had the last 18 months or so dealing with IFRS 15, which is the new standard dealing with revenue from contracts with customers. As in a lot of write-ups and summaries on the standard and presentations that we've done at RSM, we would have dealt with the so-called 5-step principle, the 5-step that need to be followed in recognizing revenue in terms of IFRS 15. The one that I specifically want to just highlight is that of step 5. So step 5 is quite specific and it deals with when you are allowed to recognize the revenue. The general principle is you're allowed to recognize revenue once your performance obligation has been satisfied. That meaning once control of the promised good or service within the contract has been passed to the customer. So in this period of time, if there are delays in satisfying that performance obligation, or you're unable to pass control over to your customer of the promised goods or service, you might have done the work, but control hasn't passed yet, then the revenue may not be recognized. So that is just something that will have to be delayed, and you can't on a monthly basis now. If you've got a service kind of type of revenue that you would have just recognized each month, if you're unable to perform your obligation and satisfy your performance obligation, unfortunately you would be unable to recognize that revenue until such time as control of that promised good or service has passed. Over to you, Henk, for the next bit of slides.
Okay, sorry, I was just on mute for a moment. Thanks, Mike. That last point that Mike made was very important. That is that the revenue is not that we can't recognize the revenue. So the problem is that the expenses might continue. Some of the expenses might continue, but you can't recognize revenue. And that takes us into the next slide. Going concern. It's probably the biggest question that we get all the time is on going concern. The financial statements are prepared on a going concern basis, which means that we assume certain values and certain outcomes and so on. And now what's going to happen if the company's going concern status is in doubt? The answer is actually we simply don't know. There are some simple cases, and maybe some of you are on one of those extremes. The good extreme to be on is to know that you are definitely not, that you definitely do not have a problem. You have sufficient access to cash and or finance at least, and you will be able to see this through. That's the one extreme. The other extreme that you don't want to be on is to know that you are definitely not a going concern. Those two extremes are either, although they're very difficult, very different, they are much easier to deal with than the gray area in between. The bottom line is, or the most important message, two messages. One is that you need to revise your budgets. You can't just, as you know, obviously carry on with the budgets that you've had in the past and the assumptions that you've had in the past. You need to revise it. Going concern or the implications of COVID-19 might not be so negative directly on your business, but what about your suppliers perhaps? Will they be able to supply? Will their suppliers be able to supply so that you can produce and then supply to your customers? Your customers, when they go back to business, will they need the product immediately? Will they be able to order it immediately? And when will they be able to pay again? So you can see there's a lot of considerations and there's a lot of variables here. And as I said in the beginning, for that gray area in the middle, we simply don't know. You need to, I would say, break your consideration up as far as the accounting is concerned. Look at the first 12 months after year end, and then look at thereafter. When, let's say your year end was 31 December 2019, for the first 12 months, what are the chances of the company surviving in, or the whole company surviving in operating, normal operating capacity? Or will it be necessary to curtail some departments significantly? That you have to do a proper budget forecast for the 12 months, cash flow, everything. And then also, obviously, you can't just ignore the period after the 12 months. Thereafter, what is going to happen? Because I'm sure that the effects of what we are going through at the moment, we're going to feel for years and years to come still. So at least look at those two periods. And as I've said twice already, we simply don't know. So if you don't know, all you can do is disclose. Just make full disclosure of the assumptions that you've made. There are some countries, I believe, where they are saying, all right, let's assume a 0% growth rate. Let's all prepare our financial statements on that basis. We don't have something like that in our country. You're going to make your own assumptions, but at least disclose your assumptions. And once you've disclosed your assumptions, obviously disclose the sensitivities as well. We assume a 0% growth rate, but if it's a -1% growth rate, or if it's a 1% growth rate, what difference would that make? How sensitive is our business to those assumptions? And then also the significant sources of uncertainty, all these things that we just talked about, the things that you and the directors talk to each other about. Will our suppliers be able to pay? What happens if the rand continues to depreciate, or if it recovers like it has recently? What happens then? We have to disclose all those sources of uncertainty. Remember, the purpose of this is the financial statements should paint the picture. The financial statements should be useful for the user. We can't just say in the beginning, we simply don't know. Just at least say what you know, and well, disclose your assumptions and move on. At least try and provide what you can provide. There are a lot of people that are just making blanket statements at the moment. I think we need to stay away from a blanket statement, because that just deteriorates or detracts from the usefulness of the information in general if you start putting like a boilerplate statement in. And then the second most common question that we get is subsequent events. So let's take three scenarios. First, you've got a 31 December 2019 year end, then February 2020, 31 March 2020 year end, and then thereafter. I say three, there's actually four scenarios, but I want to cover the first two, the middle two together. The first one, 31 December 2019. What happened with COVID-19 is COVID-19, obviously it's a subsequent event, it's something that happened after year end, but is it adjusting or is it non-adjusting? It seems like most experts are in agreement, and that is certainly the RSM official view as well, that if you have a 31 December 2019 year end, 31 December 2019, then it is a non-adjusting event. At the end of December 2019, if you can cast your mind back, it feels so far ago, so long ago. But then COVID-19 was I think, a mostly unnamed virus that has shown up in an isolated place in China. So it hasn't really had an effect on our business yet. So if you have to look at the information that was available at 31 December 2019, the situation in the economy worldwide, probably COVID-19 has not had an effect yet. So you are probably going to disclose it as a non-adjusting event for December 19. Then we go to February. We've also got the odd one or two entities that have January year ends. So let's look at those together, January and February year ends. There, I think you would look at, because then we were right in the middle. Well, not right in the middle. We are right in the beginning of the COVID-19 events. There you would need to look at your business specifically and look at what the impact would be of COVID-19. So would it impact impairment? Would it impact business? Would it impact ECL? What does it impact? And then you consider whether that impact has taken place already at 29 February 2020, or has it not yet? We simply know about it because we know about it afterwards, but nothing has happened at the time. So important, you need to decide based on the information that you would have had on 29 February 2020. Look at the condition of the world at that stage. Maybe you find information later, but it existed on 29 February 2020. Then you need to take that into account. Why I looked at March 2020 separately is because March 2020 is falling right in the middle of the lockdown period. So that means if you have a year end and you need to do an inventory count, well, you can't, because you can't get to your inventory, or even a fixed asset verification or something like that. You can't do it because you can't get to your inventory. So there you need to look at your circumstances and engage with your auditors and see what alternatives you can do. It's not impossible to do an inventory count when we go back to work. If you can show that nothing has changed, so nothing has moved in that period, then we can do an inventory count. We also have clients where the deadline for reporting is before we go back to work. Well, in that case, there's not much you can do. But look at the alternatives. Maybe you can do it at the end of April and roll it back if you give very good systems in the period in between. So it's not impossible to do an inventory count as the stock was at the 31st of March, but it is going to be, to say the least, it's going to be very difficult. And then, unfortunately, as I said earlier, this is going to stay with us for many years to come still. And at the end of, let's say, the first year in 31 December 2020, we're going to have to account for this. And now you're going to have to account for it completely differently. And you need to look at all these issues that Mike just mentioned, impairment, and do you recognize the revenue? When do you recognize? And things like that. So back to where I finished my previous slide, and that is, if in doubt, disclose. Again, we just don't know what the effect of COVID-19 was, but then maybe in your director's report, it might be necessary to put it in the notes to the financial statements, but note what you think is the useful information for the directors. Nobody is going to think that you are unprepared or ill-informed if you do not have all the information, but at least put what you do have. Again, as I said earlier, the important principle here is that your financial statements must be useful for financial economic decision making for the users. So that's a very difficult one, but we must make sure that it's useful. It's all very difficult, I suppose. And then coming from where I come from is the audit side. Mike covers the accounting side. I need to just quickly look at the audit issues, because if you are, most of you on the line are financial accountants, financial directors, etc., you are going to have to deal with the auditors at some stage on the financial statements. And just quickly, a few things that they are looking at and that you can expect here. The auditors are going to struggle with limitations on the availability of evidence. First of all, there is a physical limitation. They just can't get to the evidence. So if your audit is if you're in the middle of your year-end audit at the moment, and the auditors need to look at something, they need to look at, I mentioned the inventory already, or an asset, or certain documents, or they need to observe a procedure or something, they physically can't do it. So that is something that the auditors are battling with. And they are trying to find alternative ways of doing it, but there are going to be some cases where we just can't do it. And then beyond the physical constraints, there's also the uncertainties that we mentioned on the previous slides. If you are struggling with impairment or probability of default, or can you recognize revenue or can't you recognize revenue? If you are struggling with it, imagine how much the auditors are going to struggle to get their heads around it and to arrive at a conclusion as to whether your financial statements are fairly presented or not. So you might end up having to use all sorts of various different documentation, be creative to try, well, not creative accounting, but creative in showing the auditors why an asset may or may not be impaired. Show them your thought process, go through the whole process to remove all the uncertainty that we possibly can. And we just don't know sometimes. Sometimes we are going to have to live with an uncertainty. What do we do then? If there's an uncertainty that we just can't get around, it is so significant that it actually means that the range of outcomes makes the financial statements almost useless because the outcome could be anywhere in that range. Well, then you might end up with a scope limitation where the auditor is simply not able to express an opinion because it is just too uncertain, either because of the uncertainty around the accounting treatment or because they just physically couldn't do certain work. For example, I mentioned already that an auditor might want to see a procedure. For us to rely on controls, we want to sometimes see how certain controls are exercised. So if you have a control that there is a gate control to before inventory leaves, then the auditor wants to see that control in action. And obviously in lockdown periods, the auditor can't do it if they have to do it remotely. So they need to change their audit approach. You might find as a result of that, that the audit approach might have to become more substantive, less reliance controls. That means obviously more costs or maybe a delay or something like that. So I'm just saying that you can be prepared for when the auditors come around. And then the auditors are going to rely a lot on your assessment as management of these, a few things, all the uncertainties around COVID-19. Mainly, or first of all, the going concern status. What does management think? One of the first questions that auditors will ask you when they go in is going to ask you, did you think about COVID-19 and what are the implications for your business? We've had some discussions with some of our clients already, very constructive. It looks like our clients are very well prepared. They thought it through very well. I hope that you're in that bucket. If you are not, please give us a call, and we've got us in the technical department, the legal department, HR, they can all assist you with this. But we need you to make an assessment first. You understand your business, you understand the impact on your business, and look at the going concern status and make an honest assessment. The auditors are going to need that as a starting point. Also, the need for impairment. The auditors are going to ask you, are you still using these assets productively? Do you honestly think that if you close this business line, that this asset is not impaired? Do you honestly think that your debtors will still pay you in the same pattern that they used to in the past? Or do we maybe have to look at a probability of default slightly different to what we had before? And then keeping in mind that we've got so much uncertainty, if we look at the financial statements and we just step back, does it paint a picture? Is the disclosure adequate? We've got one more slide after this one where Mike is going to take you through just a few items that you need to disclose. Make sure that those items are disclosed and properly disclosed. Again, that is just the lesson is that the auditor must be happy that the financial statements paint a true picture to the users of those financial statements, whoever those users might be, and bearing in mind that those users might well have changed now with COVID-19. Okay, and then if you look at the next column there, what could be the possible outcome of your audit? One is we would obviously like a clean opinion. You can carry on as usual, and the auditors are happy they managed to do everything, and the financial statements are fairly presented. Hopefully we will get to that in 89% of the cases, 90% of the cases. Then another outcome might be an emphasis of matter, where the auditors are happy the financial statements are fairly presented, but there is something so significant, maybe COVID-19, maybe a subsequent event, maybe going concern. There's something so significant that as auditors, we would like to draw the attention of the user to that matter. So that can become an emphasis of matter. That's not a qualification or a modification of your audit opinion. It's just emphasizing something. And in this same category would fall things like key audit matters. If you are one of our listed companies, listed clients, then we might actually list it on our audit report as a key audit matter. you don't see it a lot in the unlisted entities. Then we get to where we start becoming a little bit too uncertain to issue a clean opinion. So there we can have a qualified opinion or an adverse opinion. Qualified opinion could be, the two main reasons could be mainly because of a scope limitation. You're happy that you could audit most of the financial statements, but there's some aspects that you can't audit. Then you'll get a scope limitation. And then lastly, qualified because we disagree. Or it could be even worse, adverse because we disagree. So management says that the asset is not impaired. We believe that the asset is impaired. Or management believes that it's a going concern. We believe it's not a going concern. It's very unlikely that that would happen, very extreme cases, but we just need to point out that that is also a possible outcome, a disagreement, and that results in an adverse opinion or a qualified opinion, just depending on how severe that disagreement is. Okay, so that is just a few of the audit issues that you need to keep in mind. I'm going to go back to Mike now to just tell us about the disclosures, and then Mike, you can just close it off for us now. We've got 4 minutes left. Thanks, Mike.
Thanks, Henk. Yes, I just wanted to add my 2 cents worth on disclosures as well. Henk has stressed it quite, and rightly so, quite importantly, the need for adequate disclosures in the financial statements. I also always tell everybody, as soon as we get to a point where we need to talk to each other or question or consult on how something should be accounted for, we should consider disclosing that. This is the time now where we need to get away from those standard financial statement template kind of disclosures where we're just switching things on so that it looks like we've disclosed something, but we should actually be considering what we're disclosing here. And the first area would definitely be in the accounting policies under the significant judgments and estimation uncertainty note. We all know it's right in the beginning of the accounting policies most of the time, and that we really need to consider what we put in there, and we need to deal with the assumptions that we've made with regards to our impairments, be it of PPE, be it of inventory, be it of our expected credit loss. And also then very important is in the actual notes. So if you've got a goodwill or intangible assets, you've got to disclose the assumptions that you're using in determining the value of your cash generating unit. We need to disclose those assumptions, why we've made certain decisions, and this is the time now to make it clear so that nobody ever questions what decisions you've made or what assumptions you've made when they read your financial statements. And the only way we can do that is through communication, through disclosures. So Henk's already dealt with the disclosures of subsequent events and going concern assumptions, and we need to consider whether those need to be, if it's adequate that it's just in the director's report, or if actually those should be in the financial statements as well, and make reference to that and actually disclose the assumptions and the decisions, like I've said, that we have made during this time. So disclosures is very, very, very important, and I can't emphasize that enough, of that adequate and proper disclosures would paint the picture, and nobody then can question at all your decisions that you have made if you're open about it and you're transparent about it and you disclose what you've done. So that comes to the end of our half-an-hour webinar this morning, and we'd just like to thank you for your time and thank you for joining us. Henk and I are available if you've got any questions, or if any questions come through, we'll get those questions, we'll respond to them. But in the times to come, like Henk mentioned earlier, if you need us, let us know. We'll be happy to set up a Zoom call, or if we are back to work, set up a meeting, and we can discuss anything or any questions that you might have around this. So yes, good luck, stay safe, and thank you very much for your time this morning.